or they like didn't present information earlier on that was key to the decision making to understand that it's how they built their plan. And if we had that information, we wouldn't have gone along with the plan. It's usually one of those three things. And at that point in time, it's like the management's the problem.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. This next guest, he helps inspire teams to beat forecast, launch exceptional products, solve colossal problems, create innovative technology, execute efficient operations, and all doing so while delivering excellent service. He has built and scaled numerous 8-figure businesses. Now he is the managing partner at Atento Capital, which has an incredible thesis of numerous different funds. And we're going to be diving into his background, his thesis, but also how he's able to really establish an incredible mythology and thesis in regards to Atento Capital. And their mission is not only to drive returns and create jobs in Tulsa, but also be an example of the world of inclusion, equality, and equity across all races. Please welcome my next guest, the one and only Michael Basch. How you doing today, Michael?
I'm good. How are you? Thank you for having me.
Man, I'm looking forward to this conversation, man, because I was looking at your background and you have immense experience. And, you know, I always like to start out with this question because I think there are certain pivotal moments in everybody's life. And if you could think about that young Michael, okay, where you scaled numerous companies to 8 figures. Now you're focusing on Atento Capital, which we're going to be diving here shortly. But Michael, if you could look back in your life and you see that young Michael, what were those pivotal moments? What were those moments, whether it was a failure, whether it was a success, whether there was a mentor that's, you know, helped you become the person and the successes that you now have? Who and what was that?
That is an interesting question. I can think of many, but I'll give one that's probably like a very specific moment that really changed the direction of my life. When I was 16 years old, so I grew up in Los Angeles, and both my parents worked in the nonprofit space, mainly in the Jewish community. And both my parents to this day are very committed to making the world better. And I was very much raised in the spirit of service, and it's called Tikkun Olam, which means repairing the world. And you know, I was always like kind of selling lemonade as a kid, and always a little bit of a capitalist myself. But when I was 13, my father got sick and stopped working, and for a year, and then by the time he kind of came back, that the role wasn't there, and ended up not working for a couple of years. And by the time I was 16, we just kind of ran out of money, and we ended up losing our house. And my mom kind of left my dad, or they divorced, and Dad had a heart attack the day we had to move out. And I remember walking in on him purple on the floor and deciding at that moment after we took him to the hospital that I'm going to be a capitalist and be financially set, because all my friends whose parents were lawyers and bankers were not having these kind of issues. And so I, from that moment, I basically started working, and for the next like 14 years, more or less 24/7, until I got to a place where all of a sudden I woke up and I don't know if I had arrived, because I would never say that, but I would say I just had financial independence. And so that was like a very big motivator for me to take control of my own destiny from that point forward.
That's interesting. And so you said, you know, I'm going to plant my flag. And was that an easy journey, or was that like you know, like psychologically, that is, you know, with the relationship with money and your work ethic, and there were certain biases or certain you know, psychological things you had to overcome to be able to have a good relationship with money and capitalism?
So I think in the beginning, it was very much a means, in that, you know, I wanted to go to college. It was really expensive. I went to USC. I took out a couple $100,000 student loans. Then I wanted to get a business school at USC as well. Took out more loans. And especially once you go to USC, you could kind of see really, like, when people who have wealth, what is open to them, you know, seeing people have parties on yachts and some of these pretty crazy things, it distorts your perception of reality in a negative way. Also, you know, growing up in LA and going to UC definitely did that for me. But for me also, I mean, I think I really felt for a long time that financial wealth was the only means of like family security. And so I really felt like I wouldn't even think about having a family until I had enough wealth to provide that security for it. And so, like, I did a little bit of dating in my 20s, but very little. Traveled a bit, but oftentimes, around work-related things that basically cover the country and a good part of the globe. And that took me to New York and London. So like there was definitely like a push to continue growing, continue learning, get outside your comfort zone, build. There was even the years that we hit our goals in my businesses, it was never felt like we've arrived. It was always like, and to this day, kind of suffer from that. Or I need to focus more on celebrating the successes versus pushing for the next milestone. But I think I woke up, I was more or less pretty one-dimensional until I woke up at 30 in a pretty extravagant scene in the south of France. I celebrated my 30th birthday with 77 of my closest friends across 5 days at the budget, about the same budget as my wedding 5 years later. And I realized this is a pretty empty life, and I felt like what if my parents did raise me to make the world better, and that really is like our purpose for being alive. And I realized that I'm 30 years old and the world is no better for me having been in it. And I didn't want to wake up. I committed to myself to not wake up at 40 and feel the same way. And so that began the process of me taking a sabbatical from my business at the time and kind of clearing my head and figuring out what I want to do next. And eventually led me the path and for a brief minute into politics, and then Tulsa, Oklahoma, which I wouldn't have guessed, and which I'm feel very lucky for. And so I think like now, thinking about Atento Capital, Atento, we really do feel is like at the intersection of doing good and doing well. There is a way to do both, in my opinion. You have to be very. It also depends how you define good and well as well. But that's what we try to do in our everyday values.
And I appreciate your sharing that a little bit about your background and kind of your journey and evolution of this. And I found this very interesting because at Atento Capital, you state very, very obviously, this is our mission, okay? It is to be an example of the world of inclusion, equality, equity across all races, genders, educational backgrounds, and socioeconomic status. And I think I see this in a lot in businesses and large corporations, but kind of just off like, we're going to go ahead and take this, equality, inclusion kind of, class, right? And you obviously stated throughout your mission, and that is your alignment, that is your values. Michael, at what point in your journey was that always like that, or when did you start, kind of putting your flag and saying, hey, this is what we're going to stand for?
Yeah, so very much wasn't like that. The business that I spent most of my 20s being built as a product manufacturing business. And my two good friends of mine from college started it, and 3 other guys. So 5 of us who were all very close friends from the same fraternity at USC. We're the 5 partners of the business. We didn't raise any outside capital, and we added a 6th partner at one point who was also in our fraternity. So 6 white men from LA represented the partnership. And when we built and sold the company, we represented the wealth that was created. And if you looked at our team, it was not very diverse, aside from the fact that we had people in physically China, India, Brazil, and some of these other countries, but our US team was not very diverse. Our leadership team was, I think, all white men, right? And so it didn't hit me so much until we sold the business, and I realized that some of the people who've been with us for a decade were like not really receiving anything. And then until I like kind of left, that bubble, I realized there's other ways of building businesses, and actually businesses that have a diversity of perspectives actually could potentially be stronger than businesses that are relatively homogenously led. And so, I started investing in real estate in 2005, started investing in startups in 2010. And as like I realized in especially investing in startups, like there's such a shortage of female-led companies, let alone female-led companies that had, venture investors. And some of these companies were, equally good, if not better than the, typical tech bro-led company in San Francisco. But they were raising at half the valuation because they just didn't have the same attention for whatever reason from VC. And if you think about from a just pure economic perspective, everyone in venture is chasing the ex-Google product manager that went to Stanford undergrad, Harvard Business School, that profile, and there's about 1 million VCs lining up to invest in that human, and that's great, and that person might do wonderful. But there's a bunch of humans in Detroit or Minnesota or from a underrepresented background that might not have went to Stanford just for whatever reason, or doesn't have the network to even get in front of a VC, that have a ton of potential, that are just typically overlooked. They're two or three introductions away from a VC. And we spend our time trying to put ourselves in front of those folks and reach out and be very actively engaging people of that profile, like, super high potential human, has exhibited grit, has exhibited high EQ, has exhibited deep purpose and a unique right to win in the problem they're trying to solve. And maybe other people would typically overlook them because they didn't go to college or for whatever reason, never worked at a tech company, but they taught themselves how to code. And we'll work with them. They might not have access to angel investors, and we don't mind being the investor, the first money in. And so we realize that not only is it the right thing to do in terms of like trying to work with folks like that, that's actually, economically could be very advantageous because you're not competing with other folks to get on their cap table. And so the terms tend to be, more mutually equitable. And so it's been an evolution. I think I used to think I should look for people that were like me. And now I realize like there's actually more often than not, the people that are not like me, that are different than me, oftentimes have more to offer because I'm kind of run of the mill, in relatively speaking, in many ways, a very, very relatively traditional. And so it's like some of the most untraditional people that really change the world.
That's so interesting because I do know that you have on your website, attentocapital.com, you guys share a little bit about like your diversity in, from women to gender to, all sorts of different things that, are part of your team, which is really awesome. I want to kind of pivot a little bit toward your investment thesis. But before we dive into your investment thesis at Atento Capital, I want to talk a little bit about your scaling of numerous companies to 8 figures. Okay. We were talking offline, you scaled numerous companies to 8 figures and beyond. Michael, what did you feel like was your gift? Because in running and scaling a business, there are certain hats that everybody has to wear. What would you say are the 1 or 2 hats that you're like, hey, I'm the best at? Was it the sales, the marketing on the front end? Was it the operations? Was it the culture? What was that for you, Michael?
Yeah, first of all, I probably could tell you all the things I wish I could do better. First, because I think I think about that more than about what I'm great at. I think actually across all up until this day, and including what we do in terms of investing, I think my greatest strength is understanding people, their motivations, their purpose, and recruiting the most talented people into my company or for us to invest in, which in turn to move to Tulsa, et cetera. And the recruitment of talent and the development of that talent is everything. I think as what Malcolm Gladwell says, get the right people on the bus. I couldn't possibly agree with that more. It's like, and so I spend, right now, like this week, I've got like 3 different folks in town for different roles of sorts, or to move their company here. And the recruitment of those people, that takes us oftentimes meeting them through someone else, having a meeting in New York or California, a bunch of follow-ups to bring them to town. We very thoughtfully understand like what would make sense for them, who they meet with, et cetera, and making sure that this aligns with their life and their purpose and those things. And then for these particular people, if they moved here, both from 2 we invest in potentially, and 1 would work at Atento, they would have significant follow-on. It'd be like a domino effect of what that would look like in terms of the impact to what we're trying to do. And so for all of our companies, like when I had my coffee shops, like I would go into the Starbucks in the neighborhood that were best run and shouldn't recruit the manager. And I'd build a relationship. I'd come in every day. I'd talk to that person, slowly, understand them, and then try and move them over to my coffee shops. And that's what I spent my time on. And that really, there's one thing that went through all of those businesses that go through to this day is the recruitment, the high level of commitment to recruitment of top level talent.
So let me ask you this, because I find this very unorthodox a little bit. And let me give a little context. I have heard where it's like, okay, if you want to build a business, you find the right people on it, you build relationships, but sometimes it's you still got to be very professional, right? There's a line. But you also want to make sure that you know them personally. You want to know kind of their family, their kids, their whatever, right? Because at the next level, right? But and I don't know if that's on the line of too personal or too business or professional or whatever it is, Michael. And it sounds like you went out of your way to build a community. Like, for example, that coffee shops, you went to Starbucks, you went to these other locations, you had amazing connection and synergy that they just would like gravitate toward wherever you were going as well, which was obviously you mentioned the coffee shop, which was your end all be all. Michael, how do you deploy that? What is your perspective on that in regards to, Atento Capital, as well as your other companies that you scaled in regards to, that personal, but also professional, but also you're getting the most out of them? What would you say?
So it's interesting. I think, with in the coffee shops at the end, I had 400 people across 19 stores. There was a point in time where I'd know every barista's name, and I really liked that. And I'd come in, and I'd know every person in all my coffee shops. It got too big in the product manufacturing business. When I left, and when we exited, some of the guys we sold to coming through, the 5 guys are still there, but I think it was around 150 people. Even at that probably at 120, we stopped knowing who everyone else was by name and a little bit about them. I don't think I'll ever be a CEO of $1 billion company, because I don't think I enjoy a company that's so big that I don't know folks deeply. And I like to have a real relationship with the people there. I'd rather have, right, we're about 25 right now, and that's a great size for us. With our portfolio, you're in the hundreds, possibly thousands, but I know all the CEOs. And so I think there's not a right or wrong. There's different people, different companies at different stages require different aspects of this. I think once you get to a certain size where not everyone's going to know everyone, or like there's just a ton of layers or a ton of geographic disparity, Google's not going to know, what each individual software engineer, product manager has going on. But some companies do have more of a culture of like, fully immersive, holistic understanding of their team members, and some say, keep it very professional, and there's work and there's not work. I subscribe to I'm very involved. I encourage our management, we call them Atento management because they're managers at Atento, to be very involved in people's lives. And every one-on-one, we ask people how they're doing personally on all professional development. There's personal and professional. We have people set personal and professional goals. And so we see our people as like a holistic being, and we need to make sure their personal life is in strong order so they can show up well for their professional life. And also because I think every day, this comes from being at a coffee shop. At a coffee shop, you are usually the first person that someone sees in the day. And you can, depending on the experience you give them, you can set someone's day on the right foot or the wrong foot. You can make someone's day or ruin someone's day. It's a lot of pressure, actually, if you think about that. And if you think about just also showing up to work, you're the place that many people spend much of their time, basically the most time aside from their significant others, probably at their office with their coworkers, or even remote with their coworkers. And so the experience you provide and what that's like, has a huge impact on people's lives. And if it's horrible, then you're also like kind of emptying their cups when they come home to their family. And so we try and do the best we can, in the spirit of like paying things forward. If we do all we can for our team members, Atento means helpful in Spanish, to try and be helpful to them in their lives. Our hope is they will then go do that with our founders and also their friends and the people in their lives, and that'll kind of continue to exude outward. So we're we try and live that value.
That's so cool because, culture right now, that terminology is so well known right now. It's like the hot, sexy word. And what's interesting is at the end of the day, if you tear it apart with culture, it's relationships, understanding, your people, understanding what that is. And I like what you're saying. You as a leader set that cadence and exudes throughout your organization, because then your mid-tier management, your low, whatever management, whatever that is level, they all exude that. And then you see that trickle effect. Michael, I want to loop into Atento Capital because you guys have an incredible thesis. You guys really focus on the Tulsa area. For startups, and you guys are willing to come alongside those companies. Michael, it sounds like to me you have a very industry agnostic. You have several funds and co-investments and partners that you work with and collaborate with. And if you could just share with you, Michael, when you look at a pre-seed, pre-rev investment, what are you looking for? Are you looking for more of the founder? Are you looking for more of the idea and the opportunity and the market possibility, the market penetration? What does that look like for Atento Capital?
So I think where do we start is, well, first is what is the problem this person is trying to solve, and is this a problem that we care about? For example, someone's trying to, I remember, someone approached us trying to solve something to like help guns shoot faster, and like I'm not a huge gun person, and so to me that isn't something I want to spend time thinking about. And so I wasn't the right investor for that company. But if someone's trying to say, hey, we're trying to create reduce plastic waste in cleaning products by having zero environmental impact cleaning products, like, yeah, okay, that don't compromise on quality, that could be interesting because we have a real plastic waste problem, and I think about that all the time. I'm worried about the climate, and so we invest in that company. It's called Clean Coal, and so it's doing 8-figure revenue itself right now. And so one is the problem that they're trying to solve something that we care about solving, that we'd want to spend our time thinking through and brainstorming and helping them to solve. So that's like the foundation of the, whether or not we take a meeting. Then we don't care as much, believe it or not, on the solution, because the solution is important. We have to agree with the framework of the solution, meaning how they got to that solution. We have to agree with, because that's how their mind works. But the company will likely pivot 1, 2, 3, 4, who knows how many times to survive until they figure out where they're going to land. Facebook started off as like almost like looking at pictures of college people, right? Like now look at it, it's like a metaverse, right? And where companies start are not where companies end. Amazon started selling books, and but it is the problem that we must agree with, the solution we must agree with, the framework of how they got to that conclusion. And then really and deeply, it's about the founder. Now, there's things we have to do, like look at the total addressable market. Is it a big enough market that if they win, it'll be a multi-billion-dollar company? What's the competitive landscape like? Are they solving something uniquely that's not being solved today by someone else? And if it isn't, is there enough of a moat that would stop someone else from doing it? And so these are things that we're like looking at closely, but really holistically, pre-revenue, pre-everything. Like, who is this person? Why is this person trying to solve this problem? How is this person uniquely qualified or have the right to win in solving this problem? What are their motivations? How does this tie to their personal purpose? Are they someone that I'd want to work for? Are they or someone that we think will be able to recruit talent? Is another way of saying that. Will they be able to convince people to do rational things, such as convince someone to write them $1 million check, convince someone who's making $400,000 at Google to take a 50% or 60 or 70% pay cut to work for them because they'll believe in the future, convince a customer to give them an order or convince a potential customer to be a customer off of a deck before they even have a product. And these are all like kind of irrational things that this person or people must be capable of doing. And so we spend a lot of time on that. But like holistically, when you invest in a company, it's kind of interesting. The motivations are super important, because if it doesn't tie into their personal purpose so much so that they have to do this, that they can't, they must do this, or their life will not be complete. Building a company is really hard, and most fail. 99% of companies never receive venture capital. The ones that receive venture capital, 70% fail within 5 years, I think. And in general, the other 30%, half of those will eventually fail, and the other half will exit, but only a small percentage will have a good exit. So it's like you're talking about 99% don't even get off the ground. And the ones that got off the ground, at least 70% are going to crash land. And so it's like you need an entrepreneur that, to some extent, is willing to stick with it for so long. And usually it's just a race between, can they stick with it long enough without running out of money, or even running out of money, finding a way to survive, working nights, weekends, whatever, before they give up, to figure it out before they just give up for whatever reason. And like that is the ultimate equation at pre-seed, especially because the team is small. It's not like they have 100 people. Like, there's a small team, there's a decent chance they're not going to be able to raise more money. Can they survive long enough to figure it out? Or, there's folks in town, these two guys, they graduated Oklahoma State University. They started a carbon fiber fuel tank business, and they do carbon fiber fuel tanks for rocket ships and airplanes. And carbon fiber weighs less than steel, and it explodes at a higher temperature than steel, and it costs the same, basically, / less. So everything about it is superior to current fuel tanks for spaceships. And these guys, it should be a good company, but they couldn't raise money. They were young kids. A million hard things happened. They've had to recapitalize the business 4 times. They were living on, one was on a couch, one was living with his girlfriend or / fiance. And like they just survived long enough forever when like any rational person should have definitely quit. That now they have like a, I don't know, 7-figure approaching 8-figure revenue business, 20, 25 people with a manufacturing facility, and they're turning a corner. And so like there's now that's all to say they've been doing this like 10 years. Could they have made much more money doing basically anything else over that period of time? And like, will this work out for them financially? I do not know. But the company, they've willed the company into existence. There are carbon fiber fuel tanks in spaceships today and rockets today. And so it's like, this is what they had to do. And irrationally, even though there's other things they could be doing with their time, they chose to stick with it forever. And they, be in less than 90 days cash forever. And like, that's what it looks like. And so finding people that have that level of kind of irrational obsession with their business is the name of the game.
Well, that's why I find so interesting about the VC world. It is, you really can't look at it sometimes logically. You have to look at it almost as like, hey, do I believe in this wholeheartedly, as well as does the founder believe in it? Because like you mentioned, 10 years, very few are willing to travel that 10-year period, get hit in the face 1,000 times. But now that's a revolutionary product that would change the world. And it's just so cool because obviously people believed in them, right? But you had to, find those individuals. I want to ask you, how much would you say is luck a player into finding kind of the winners?
Mm-hmm.
Is it kind of that spray and pray kind of approach? Is it, hey, you know what, I can, look at the founder, they've had a previous exit, so the likeliness of them having another exit is higher, right? I mean, what all goes into that says, hey, what are my likeliness with my chances? Plus you see the market penetration. This is already a growing market, for example, SGE, for example, that's been really, really, powerful. A lot of money is being moved toward that, allocated directly toward that industry. So what all goes into that when you're looking at like, hey, or is it just kind of more of a luck and it's like, hey, you know what? Like 10 years, then all of a sudden you start seeing this scale to 7-8 figures, that business that you just mentioned. What are your thoughts on that, Michael?
Yeah. And before on the luck thing, in terms of like the irrational versus rational, on pre-seed and seed, it's less quantitative and it's more qualitative and instinctual. At Series A and beyond, is you have real revenue and acquisition costs and lifetime value data, especially Series B, it's all quantitative. And so Series A is kind of the transition from like qualitative to quantitative, but yes, seed and pre-seed's all irrational in your words. But yeah, so on luck, I mean, thinking about my businesses as I built them, as well as thinking about like the businesses in our portfolio that are doing the best, there's a component of luck for sure. You can create your own luck in a way of like, depending on like the people you be behind and these people that exude positivity that other people would want to help, and you can, I've gotten lucky multiple times, life-changingly lucky, but I also like worked my tush off and like went knocking on doors, going to trade shows, going to every booth. You're not going to get lucky sitting at home looking at your TV. So it's like you can create your own luck. If you're going to go have 1,000 conversations, something might come from 1,000 conversations. And obviously that I'm an extrovert, so that's like a very extroverted mentality. But you can get lucky and you can get unlucky. You can have a regulatory change and the business dies. I had my mobile user acquisition business went from 0 to 16 million revenue in 12 months. On the 12th month in a day, Google changed literally Google changed the requirements for how ads were served in our revenue, which was like doing a $2 million monthly run rate at that point in time, went to 0. But then we pivoted to Baidu and we were at $1 million monthly run rate, less than 30 days later. So like you can get unlucky. A different business we're in is a prescription adherence business and called Patch RX. And after we invested in it, Medicare announces that they're going to start reimbursing for prescription adherence at like over $2,000 per patient per year. So all of a sudden, this business that was going to sell to pharmacies all of a sudden gets reimbursed by the federal government, and that's a very lucky circumstance for us, right? And so it can go either way. I think if you get behind the right people, you can find people who have a higher likelihood of getting lucky. Now, in terms of what you said in terms of profiles, look, there's like a lot of data on this. If you wanted to like just, there's people that like, there's funds that just spend the time only investing in second-time fund managers with exits, second-time founders with exits. if you look at it, there's like HBS has like a whole write up on this, but like the average unicorn founder is like 43 years old, has had a previous exit, worked in management consulting, has an MBA from one of 8 schools. Like there's a very specific profile that will have the highest likelihood of a unicorn founder. And you could just spend all your time in that. Now the negative on that, and we're in one deal like this, is an exited founder that sold a company for $850 million, is now building a new company in the health tech space. The seed round, which has Thrive Capital, Google Ventures, and some like Who's Who Venture, was like at a 40 million pre. That's like 7 or 8x what our seed round in the company we would lead would be, right? So it's priced in to the value is of like there's a high likelihood this guy's gonna build a monster, but for like that means this guy has to get like a $4 billion plus outcome for just to be 100x. It's actually post is like actually $6 billion plus outcome. So the answer is, you can definitely profile to increases your chance of getting lucky. There's a lot of people doing that. So we choose rather to be contrarian and bet on ourselves and having a better eye, or looking where other places aren't looking, to have something that's off market and priced better in relation. We think we can underwrite downside risk better of people that don't have the profile of having a high likelihood to succeed, therefore outperforming the market of venture for everyone chasing the small subset of founders.
I love that approach, man. And I do love your approach in regards to luckiness, right? If you go out there and have 1,000 conversations, the likeliness of you being in the right spot or the right conversation is much higher than sitting on the couch watching Netflix. And then also, I really appreciate in the regards like that kind of contrarian look. Because again, it's not like everybody can, write that kind of check to be able to play that game, right? Bet on the jockey that already had successful, races behind him. Michael, I want to ask a little bit, when you're looking at your portfolio company, there are certain things that are happening in the industry. I've heard some people with their portfolio, they're saying, hey, you know what, make sure you have cash reserves up to 2025, making sure you have a good runway, and just in case, streamline everything, simplify everything, make sure your burn rate is relatively low. What are you saying to your portfolio company, or maybe advising them on, or certain things that they should be just preparing themselves in this kind of, this period of time?
Yeah, so it's a unique moment where cash was vast. It is now scarce, and there's funds that are out of capital that can't re-raise, that can't protect their positions, which has led to, let's say a fund led the Series B of a company, but they're out of capital and the company's like not ready for the next round. They can't protect their position. All of a sudden, like the Series A and seed investors have to come in, oftentimes in a down round, recapitalize and squash out that Series B investor, because to us they're like dead weight, right? Like they're not, whoever's the most recent investor who led the last round is the one that gets like kind of, you're passing the football. The one investor, the other investor, as the rounds go, if they can't protect their position, then all of a sudden, us smaller guys have smaller funds. It's harder for us to proportionally protect, and it takes a lot of work. And so you're seeing a lot of these insider flat rounds, in some cases insider down rounds, to kind of extend the runways you're speaking. I mean, I don't know about 2025, but maybe. I mean, definitely through at least mid-2024, 18 to 24 months. Most of those extensions were done at the end of last year. So I think I would say now it's like 18 months out, but yes, essentially. And I think you have like SoftBank and Tiger doing seed rounds, like the world is upside down, and we need less capital in venture. We need the best companies will still get invested. We need companies that should die, so the talent can be recirculated to companies that have a better likelihood to succeed. Obviously, no one wants their company to die. I will say it for our, we haven't had in our local portfolio any companies go to zero yet in 3 years. That shouldn't be the case, and that will change definitively in the next 5 months. And I don't think it's not necessarily great for my performance, but I think that's probably what needs to happen. And hopefully some of the folks that did that learned a ton, and they either go work at another one of our portfolio companies, and it can still be a win for what we're trying to do. Because not every company too many companies that shouldn't have made it have been making it further than they should, and that throws off the equilibrium of talent that needs to consolidate around the winners. And so I think this is a needed correction. I think these huge tech layoffs is great for startups, because we're now able to get talent at a reasonable price that previously we're just like staying at Google and Twitter and everywhere else. And so and I still think we're not at all at bottom. And so I think like you're gonna see 6 more months of just like this all shaking out at least. And then I don't know. I'm not I know what I don't know, but I do believe that we're nowhere near the bottom. I think public markets got 20 to 30% more to go down. And I think enough companies have raised capital to extend that still will not be able to raise an up round. And I think at that point in time, to start seeing things fire sale or die. And that will start happening in Q3, I believe.
Yeah, this is interesting. I appreciate your kind of thesis on that. And I'm curious, when you're looking at this situation, and maybe just like, portfolio companies in general, because we understand that, like you mentioned, 99% of them don't get funded, right? Businesses. And then out of the ones that do get funded from a VC, 75% still don't make it to the next level, right? To 8 figures and beyond. And with that being said, Michael, are there certain, hurdles that you like to see on a 5-7 year journey that say, hey, we're on target, we're ramping up, cool, wonderful, fantastic, with the portfolio companies that you have? Or are there some hurdles that are like, okay, that gives you a red flag? It's like, hey, why haven't we gone to, we've raised a lot of capital, a lot of it's going to R&D, like that's a red flag. Why haven't we, go to market strategy? What does that look like, for your kind of journey in those companies?
So there's a lot of different things that can show up as red flags. At the core, if we're in agreement with the management's thought process and rationale, and how they're approaching the market and what their strategy is, and if they do what they say they can do, meaning if they say to me, hey, we're seeing this, we think we need to make this adjustment, or our plan is to do this, or our plan is to cut our team, our plan is to increase our team, and we think that if we raise this, we hit this milestone, we'll be able to raise capital. If we're in agreement with that, they do that and they deliver on that, and it ends up not being the case, we'll still continue to engage, most likely. And if we need to reinvest, we'll reinvest. It's when management either like most of the time, it's they either change their plan without bringing you along with it, and you don't agree with that change. They don't hit their plan, or they didn't present information earlier on that was key to the decision making to understand that it's how they built their plan. And if we had that information, we wouldn't have gone along with the plan. It's usually one of those 3 things. And at that point in time, it's like the management's the problem, and that's very hard. It's not impossible, but it's much harder. It's much harder to develop that if management's the problem, especially early on, because the management's the only everything, and that's the bet. And so the ability for us as investors to work well with leadership early on, oftentimes, unless it will be the difference of the company, simply because we're the capital, and they'll usually need more of that early on, and anyone else that comes in will probably ask us what it's like working with them. And we would be honest on whatever that looks like. Now, sometimes it's personalities, things, and that's why you got to do what you can to understand the relationship going in and try and meet them, try to get to know them as best you can pre-investment. But I don't know if that answers your question. Is that helpful?
It does. And I really appreciate re-emphasizing again the founding team, right? Because it's a marriage, right? You go in, and so that's why you unpack and you take some time understanding the founders, understanding the team, et cetera. Because at the end of the day, hey, you know what? If they're not doing these things, or they're not open communication with you and the team, yourself, Michael, then that's like a red flag for you. I'm also curious down the road when they go to market, and maybe they're at Series A. Are there certain things, because maybe your strategy is slightly different. A lot of times VCs, they don't take an advisory, or they're not on the board. Are you guys on the board where you guys are able to have voting rights?
So in pre-seed, we don't put together boards. It's just too early for that level of governance. At seed, we do much of the time, but sometimes we bring another seed fund leads, like we'll lead the pre-seed, another seed fund will lead, and then we'll take an observer seed and let them kind of take it from there. And that's a win for us, because then they're in charge. Whoever's on the board is in charge of bringing the next round of capital. So it's a real responsibility. And it's oftentimes a 7 to 10 year commitment, right? And so you can only have so many board seats. They say you shouldn't have, 10 is 8 to 10 is where you want to be as a GP in a fund, no more than 12 typically. And so if you're thinking about that, and these board seats can last, on the short side, 3-4 years, and the long side, 7, 8, 9, 10 years, you got to be very selective as to what board seats you take. Because it's really it's a long-term commitment. And at times the company could outgrow you, so you'll hand it off to the next investor. But sometimes it doesn't work that way. And I would also say, remember, we're so heavily underwriting the founders that we're hoping we're investing people we don't have to tell them what to do. That there's a really good relationship and we can have a two-way conversation. And so we're suggestive investors, is how I describe it, versus dictator, tyrannic investors. At times some of our founders would describe it that way. So we have strong opinions and we'll make strong suggestions, but we won't force things. And I don't know if that's a best practice or not. It's just what we've decided to do. And I think it most of the time is positive and some of the time isn't. But as an example, if we move someone to Tulsa and they decide after 6 months or 12 months or whatever that they hate it here, if I had a board, I could force them to stay. But do I want to be in the business of forcing people to live somewhere they don't want to live? That doesn't sound fun. That sounds horrible, actually. And so I don't, so sometimes, I think that if we can align with our founders on 80% of the time, and hopefully 95% or 99% of the critical things, then I think we're in good shape. Even if 20% of the time we see them it's like your kids. You see them making mistakes that you told them if you put the finger on the stove and burn your hand, but they got to do it, and it's it's very much what it's like. And sometimes you just got to accept imperfection.
I appreciate that, that honesty as well, because at the end of the day, that kid always, touches their hand on, and they'll figure it out themselves, and sometimes you waste 6 months of their life and your life. It's like, well, if you would have just listened to what I said the first time. So highly suggestible, kind of, that's kind of your focus point. When you're working with some of these founders, and I want to talk specifically because you're hitting Series A, and Series A, that's where you start getting that go-to-market strategy. You've got some revenue, you've got some momentum, you got some, tailwind behind you. Okay. Yep. What is this? What do you like to see as a go-to-market strategy? As in, and what I mean by this is their approach. Do you like to take some of the money and deploy it into sales and marketing and say, okay, hey, let's test this out and see where we can scale this? Or do you like more strategic partners, or is it just through, connections? Because depending upon, I know it's very contextual, but I guess that's why I wanted to get your opinion on that. How do you like that approach?
So look, it varies heavily business to business, and consumer is very different than B2B. And I probably spend more of my time in B2B, so I'll talk about B2B. In the beginning, I want them to have deep relationships where they're talking directly to customers so they can understand the pain points of customers and continually adapt the product to really get their customer profiles down, the customer archetypes down. And that's pre-seed and seed. At A, you need a repeatable motion. And so it's what is the way this is going to be repeatable? We can hire an army of people to do this on repeat. And that could be SDRs and account managers, account executives, and all those types of things. I've built my businesses traditionally with channel partners. Those could be agencies or intermediaries or something where, okay, we can cross-sell each other's products and do revenue shares or things like that. And I spend a decent amount of time brainstorming things around that with our founders, because it's oftentimes not where their mind goes usually. So in summation, in the very, very beginning, directly to your customers, talking to them deeply, understanding the problems and making sure you're solving them. Moving towards repeatable motion and figuring out mutually beneficial channel partners.
And that's what I find so interesting, because, and I appreciate you mentioning just go to B2B world, because, I do know in the B2B world, the sales cycle on the front end is a lot longer, but when you're doing, synergistic partnerships or collaborations, you can close that sales cycle and increase that revenue on the back end. Michael, when you're looking at, exiting, okay, and I know we're kind of pivoting here because I want to make sure I maximize your time here. But when you're looking at, 5 to 7 years, okay, you're looking at exiting. What is your approach? Do you like to go more IPO? Do you like getting acquired? Do you like maybe even a SPAC? I've heard numerous different kind of processes. Which one do you lean? I know it's probably, again, it's a very contextual, depending upon the situation. But how does Michael and Atento Capital think about it?
So I've not personally had an IPO. I've had a bunch of exits. I'm a director on a SPAC that's still trying to put a deal together that has a target that hasn't been able to close for a year because the market. SPACs are, let's say, mainly dead right now. IPO market right now is also dead, but nothing we're in is like so close to an exit that they would be looking at IPO. But in a regular market, if you can IPO, I think the top of the top choices might be a strategic that values you in a really unique way. It's like not a multiple in revenue, multiple in profit, but they're highly strategic. Like they're going to value you because you're saving them a huge amount of money or because you're unlocking something for their company, their larger strategy. That's usually the best case scenario. Next best or even equal is probably IPO. After that, it's like acquisition, and then is depending on who's acquiring you and what this can mean to the company in the terms, cash versus stock versus earnout and it can mean a lot of different things. And so, but mainly, we want the founders to take the company as far as they can take it, and still as long as it still has, up and to the right projections, especially if it's at a point where it's profitable and controlling its own destiny. We're long-term capital, so we're not typically like pushing for a quick exit. Like we want to build it. We can be patient capital, and because it really starts to compound. If you invested a company at $10 million valuation, it can get bought for $100 million. That's a 10x. I'm overly simplifying. So you get 10x in your capital, okay, but a 2x from there to 200 million. On one hand, just as a 2x from that doesn't sound so exciting, but for your original $10 million investment, that becomes a 20x from a 10x. And so if it can double in a year and go from 100 million to 200 million, you went from a 10x to a 20x. I mean, that's a huge. That's where that compounding interest really starts to add up. And so, like when you're in early, and you don't want to get too excited by whatever the outcome is. If it has a real path to a much better outcome. Further, now it's obviously risk involved with that, macro risk, micro risk, who knows what, implosion, but you don't want to rush an exit.
I like your approach in that regard, because at the end of the day, when you are pre-seed and you have gotten in so early and you're seeing the momentum, the tailwind behind that company, and you're getting that $100 million kind of valuation, and then, hey, you know what, within 3 years it could be $1 billion valuation, you're scaling, that's a unicorn status. And that's kind of the way you structure it. It's not like, hey, in 5-7 years we got to exit, we got to find an exit strategy. It's more of contextual. And so I'm curious in regards to you mentioned SPACs, and I want to loop around on that. You mentioned SPACs are kind of dead. Why? Because I know Chamath, he talks a lot about SPACs, and he's like, the SPAC king, if you will. And I'm curious what your thought process on regards like SPACs and what's going on right now.
So it's about sentiment. So I think like something like 130 SPACs got closed in the second half of last year because they weren't able to find targets. You look at was it Bird or like a lot of these electric vehicle companies, scooter companies, some space companies, like a lot of these really hyped companies that SPAC, investors lost 90% of their money before the lockup ended. You go look at Bird's stock price at time of SPAC, and then at time of post lockup, go look at Canoe's. And so enough, most of the institutions have been burned enough that they say they don't want to touch this because the diligence on a SPAC is not the same as an IPO from an investment bank. So it's much riskier for the investor because it's not being third party diligence by an investment bank. And your retail investors that were all these kind of GameStop and AMC guys that they love this really cool thing, and they're all jumping in. They don't have their stimulus dollars. Inflation's tough. They're just not active in the same way. And in general, they're not sophisticated investors. And so I just think could the right management team, do a SPAC, acquisition to the right company could happen. And the market will reply to it could, but now it's all about what's called your pipe and making sure you have investors. I'm on the board of a SPAC and we have a target. And before, if we've filed our papers, and like, but before we list, like, we want to make sure we have a pipeline of like investors who are going to invest on these terms, so it's like kind of locked in. Even if no other investor in the market's interested at all, so like we're not going to lose our shirts on it. And so like, and the price is going to be based on the current public multiple, and the multiples are all low and suppressed right now. So the company has to be comfortable with the terms, because they're going to be taking a huge haircut to go to the market right now. And so there's a look. Even if I say this is there's a lane for these things, but that lane has tightened heavily, so much so that I would say like SPACs have always been around. They're not a new vehicle. They just came with a huge fad, the ultimate bubble, right? And like, they will continue to be around, but they'll return back to their very narrow lane, which I think is a good thing.
I just wanted to get your perspective on that. I really appreciate that insight, because I've seen IPOs have slowed down tremendously within the last recent years, but SPACs have become a little bit more prevalent. But I love the way you think about it in that regard, because I've heard some positive, negatives in context to that. I want to loop back in regards to the way you exit. Okay, I wanted to ask this because sometimes it's good to get some of your chips off the table, but also still take a position and keep some of the position for the upscale of it, right? Or up to the right, whatever that looks like. Do you ever look at that as in like, hey, when you're looking at, okay, hey, this is 5 years, $200 million valuation, cool. With the next 3 years, it goes to $1 billion valuation, and say, hey, you know what? Maybe at $400 million valuation, we take maybe 60% off. We let the rest ride, and then we can take that 60%, whatever that equates to, and start deploying capital into some other and start the whole process over. Or do you guys not think that way? It's more of like all or nothing kind of approach. I'm just curious.
So different funds have different thoughts on this. I would say as you get to later stage, Series B, Series C, Series D, oftentimes, an investor will come in and offer some of the early investors to be bought out or some part bought out or whatever, because they want to own more of the company. I think you have to think to yourself, we are fortunate enough that the way we're set up, we don't have like, the clock isn't ticking for us to return capital because we're long-term capital. So there's not like a mandate for us to sell any positions at any point in time. So we're more thinking about like, okay, based on what we know today about this company, how do we feel about it? And like, I've taken a pretty serious secondary for a company that ended up selling, but not for enough that I'm happy I took it. I got out at basically the same. I've done it twice, and both times I've done it 3 times. One's still in play, 2 sold, and the 2 that sold, one I got out for, I would have doubled in 2 years if I didn't get out for my partial position. The other one ended up selling, but for basically the same values I got 3 or 4 years earlier. And so, but those are decisions based on where those businesses were at that point in time. And in both situations, I kept some equity in for the upside. And so it really is case by case, and how you feel the company's prospects are from that moment going forward.
Yeah, it was one time I remember when I was younger, and I was never really good at buying and selling stocks, but this is like one of the strategies I learned, the disciplines is like, hey, when your thing goes up, and hits that target, maybe 3 points or whatever it may be, I take 80% and let 20% ride. And that's why I'm always intrigued, because this is the same kind of, thesis, if you will. You want to make sure that you're able to lock in those gains whenever you can, and then let the rest. And if it goes down, it's okay. You still get locked in. But I understand where your thought process is, because you're looking at the large picture, and no matter what, because you guys start at the pre-seed and pre-rev, you're no matter what, it goes all the way up. You're still locked in pretty decent gains. Michael, I really appreciate you being on here, unpacking your story, your journey, the things that you walk through, but also just the incredible evolution of scaling, building businesses, building that relational aspect, and then also Atento Capital focusing on inclusion, equality, and equity, and really being that as the forefront, as your guys' thesis, but also as your mission. What you guys stand for. For those that want to reach out to be part of what you got going on, maybe consume more of your content, more of your interviews. I know you're very active on LinkedIn. Michael, how else do they reach out to you, my man?
Yeah, look, I'm pretty accessible. I'm on LinkedIn. I try to respond to my email. It's just attentocapital.com. If folks have startup ideas and they're geographically flexible, my team will review them. And in general, we want to see founders build, especially underrepresented founders build successful companies. And if we can help, we want to be helpful. And so I appreciate you having me, and hopefully folks enjoy this podcast.
Definitely, guys. Those links will be in the description below. I'll make sure I'll put his LinkedIn. I'll make sure I'll put his website as well. He's got a lot of good content there, so you guys can understand a little bit more about his aligned with his thesis. We just tipped the top of the iceberg. And again, Michael, I really appreciate you being on here and just sharing your incredible knowledge. I love to ask my guests before I let you go fully. Is there any last words of wisdom they'd like to share with our audience?
I'll just say only that, I feel like people on podcasts don't talk about all the things they wish they could do better. And like there's many, things that I wish I could do better today. I'm deeply think that humanity is about a race against time for how much you can possibly contribute to society before your mind is not and body is not well enough to do so. And it's with that, I definitely, I work too much. I'm never satisfied with where I'm at and want to kind of push harder. I focus on all the things that aren't going as well as I want them to and should be going better. And I think there's ways of celebrating better than I do and ways of like having better balance than I do. And there's, we are hearing all these things that have worked in the positive, but know that there's deep things that still need lots of improvement. And so trying to humanize, there's positives and there's also negatives, and same with every company and every founder and everything. And I think, finding that balance is pretty key, and I'm still working on it myself.
Well said. And I appreciate the humility knowing that, hey, you know what, you're still working on it, and that's going to be an evolution, a journey for your own. Guys, that is the managing partner at Atento Capital, my friend, Michael Basch. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.
Thank you for having me.